Howdy there, folks. Welcome into the reaction channel. 3 videos to react to here tonight. First one up is from Mav's channel, and there's a very important little segment I want to show you in this video. Basically, what Mav is saying is retail on Friday went all in, shorting the market with 3x leverage with some incredible inflows for SQQQ, okay? And he's also going to talk about, why is it retail that's making this move? Why wasn't it, let's call it big money or something like that, okay? So that's a very important clip, and I want to share that with you because it's just a very, very different perspective out there, okay? Second video I want to react to here is Ken Griffin. He's going to talk about inflation. He's going to talk about, recession, what he thinks going on with the market, those sorts of things. I want to hear what he has to say and then react to that one there. And then the third video we're reacting to here is from BTIG, basically saying, don't believe this market turnaround. It's just a bunch of BS, and we're going to go much lower, okay? So I want to give my opinion, hear him out there. I think I got some interesting points to make off of the points he makes there. So hope you guys enjoy this. As always, 19,200 plus subscribers at this point in time. Thank you very much for everybody that's here and enjoys the reaction videos. I appreciate each and every one of you always showing up for these videos. Also, just so you know, we got a massive Black Friday sale coming up for the private stock group. If you want that deal shot to your inbox when it drops on Black Friday, check out the pinned comment down there, enter in your email, and we'll send you over the deal for joining in there. If you've ever been interested in joining in there and getting access to our Discord chat, getting access to basically all our different Discord chats that cover all, a ton of different stocks out there, including all my different course curriculums on different subjects and things like that. Yeah, check out pinned comment down there. Alrighty, guys, let's get into this.
This with the heat map of the ETFs, and as you can see, the majority of names, ETFs, are in the red for the day. The major exception here is inverse indices. Those moved higher today, big time, of course. When the regular indices go down, these inverse indices move higher, such as the SPXS, the TCA, the inverse for the IWM, small caps, the SQQQs, the inverse for the Qs. And by the way, we have record inflow in the SQQQs. Now, the institutionals don't usually buy these leveraged indices. They think it's a joke. But the retail mom and pops do. And I'll tell you why. A lot of mom and pops don't have access to options trading. Options trading is scary to a lot of mom and pops. You could lose all of your bet. Number 2, a lot of mom and pops have no access to shorting. So when they have conviction that the market is going down, they buy these inverse indices. And in response to this bear market rally, the mom and pops are saying, we're not going to be fooled again. We're betting that this is going to fade. This is yet another bear market rally, and then it goes down. So they're going all in buying the SQQQs. Now, this makes me a little nervous because you usually do the opposite of the mom and pops. You follow the institution.
Yeah. So, why would retail even be in this mentality of like, hey, we got to load up SQQQ, 3x leverage, short this market? Well, because what's happened throughout all of 2022, every single time the NASDAQ starts to come back at all, the tech stocks start to come back, it just ends lower and lower and lower and lower, right? So as a more retail investor, you're almost starting to get programmed. Like, this is a script. This is what happens. So you start to kind of be like, I'm not going to get fooled again. Instead of buying the stocks, what I'm going to do is I'm going to go SQQQ in 3x leverage short this market because I'll make a bunch of money because this is what happens, right? And it's very unfortunate, but I think this is very important for everybody watching this video to understand. This is what happens time and time again in the stock market, unfortunately. Retail many times gets it very, very wrong, and it's a pretty common thread. And in markets that are crashing, usually you should be buying. As hard as it is and as dumb as it sounds sometimes to be buying in a crashing market, it usually pays handsomely to be a buyer in that market. Not maybe in a day or a week or a month, but over time it pays handsomely to be picking up those stocks. But retail usually buys the heaviest. When do they buy the heaviest? When usually the indices are at all-time highs. Everybody's in a euphoric state, and it's usually the worst time to buy. And so now retail is thinking like this is the end. It's just going to end a lot lower. And here's a problem for this, right? The more that, let's say the NASDAQ goes up 10% over the next month or two, these folks are going to lose 30% in a month. You're 3x leveraged on this. 3x leverage, and then what will likely happen? People will take massive losses and then go long side, and then the market will tank again. It's the same story again and again.
Yeah, the smart money, not the dumb money. And the smart money is actually buying the dip right now. And the so-called dumb money is bidding against the rally. But here's the thing. After multiple failed bear market rallies, the mom and pops are starting to learn. And now that we're having the fourth quarter in a losing year, the institutionals, the managers, want to score bonuses. So no wonder why we're seeing the opposite picture here. The mom and pops are betting against the bear market rally. On the other hand, the institutionals are chasing it. Interesting dynamic here. Now let's move on to the charts and see if they can
and I think another issue here is, I think, retail sees all this bad news, right? So they make this bet, go all in SQQ on Friday, right? They're seeing all this bad news. The crypto disaster. disaster. The whole crypto space is a disaster zone right now, the entire thing. And there's talk about crypto.com could potentially go under, and obviously you saw what happened with BlockFi FTX this past week. The whole space is a disaster zone. And who knows if Binance is next. It's a mess. So retail's looking at that. That has all the headlines on YouTube. It's everywhere. You can't go on the internet. I went on the ESPN app the other night, and number one headline was FTX Arena is going to be renamed something else. You can't miss it right now. Everybody's talking about crypto, but not in a positive light like it was a year or two ago. Now it's very, very negative, right? So retail sees all this devastation in headlines, and they think, okay, this has to be devastating to the stock market. But you got to understand, like, crypto is like this much. And Wall Street's like this much. Like, you can't even compare these things. And like, if at the end of the day, if Wall Street wants to keep buying, the market will go up immensely more in a pretty quick amount of time. And also, I think retail looks at the economy and they don't feel the greatest. They look at, let's say like unemployment potentially. And I've spoke about this, in several videos recently, right? That I'm expecting, unless the Fed magically cuts rates sometime soon meaning in the next 6 months, cuts them massively and takes rates back down to near zero or something like that, we're going to see massive job losses in the construction field, manufacturing, and, unfortunately, it would be some pretty big job losses too. But the problem is that's still a while away, because all this backlog, this massive backlog of construction that's going on right now from all these projects that were started in 2020, 2021, and at the beginning of this year, fueled with cheap money. So all these projects still are being built and they still got to get finished up. But those projects don't get finished up until like 2Q, 3Q, 4Q of 2023. So in terms of the major job losses, that's still a while away. In Wall Street terms, that's like a million years away. So we'll deal with that. We'll cross that bridge when we get to that bridge. But Wall Street's like, dude, we got to make money now. We don't have time to wait around and be like, maybe, a lot of people are going to lose jobs and, earnings might go down. So let's not do anything. No, Wall Street needs to make money. Wall Street needs to be out there trading. They need to be in action. And the more this rally, and I've said this, 100 times over the past month or so, the more this rally expands over the next month or two, the more it will, you're going to get this domino effect where more and more money has to continue to funnel into this, and more sideline money has to funnel in, and you get this insane kind of buying pressure because all these fund managers have to start chasing the indexes around, and you can't underperform. And like Mav says, you want your year-end bonuses, don't you? So, I think that's just a big factor, and I just wanted to play you guys that clip because I thought that was a really good clip, okay? Next one up here, Ken Griffin, U.S. inflationary path has peaked. What's his opinion on the market, where things are going, and the economy? Let's hear him.
Citadel, a $30-odd billion hedge fund, and you also operate the world's largest market maker, and that gives you access to unique sets of data and analytical insights. So I want to know, what is your intel and what is your gut telling you about the state of the world right now?
That's a great question. So the state of the world right now, there's been two.
I'm trying to remember who hates Griffin, Ken Griffin. Is it the AMC people, or is it the GameStop people, or is it both? I can't remember. I remember he was very disliked. Let's just call it that. About a year and a half ago, but I can't remember which group it was that was super mad at him at that time.
Debates.
It was like, I think it was summer 2021 or early 2021 when everybody, he had so much bad stuff about him, from like Wall Street Bet Squad and stuff like that.
Into recession, and what's the trajectory of inflation? And of course, the two are intertwined. I think we've been a little bit out of consensus. We have felt that we would not have a recession this year in 2022. And in North America, that's borne out to be true. We're highly confident we're going to finish this year.
It's debatable. We did have 2 quarters of negative GDP, which is always been the standard about, you're in a recession. We've also seen consumer confidence at the lowest it's been in ever, pretty much, from the Michigan survey, right? That's pretty recessionary. We have company earnings not in a good place. We have countless companies who don't even feel they can give guidance. That's not good, right? Companies' profits have eroded quite a bit. That's usually recessionary. So, all the telltale signs of a recession have been have happened in 2022, except for unemployment. So one thing, right? And so anyways.
Modest growth note. Now, the issue, of course, is 2023, when the lagged effects of the Fed having increased rates will really start to grind on the economy. My team, for choice, thinks 2023, we avoid a recession. I'm a little more skeptical about that. I think that for the Fed to truly conquer inflation here, we're going to put unemployment somewhere with a mid-4 handle. And I find it hard to believe we're not going to have a recession at that point in time, sometime in the middle to back half of 2023. So look.
That's interesting. If unemployment, let me say this, okay? I think this is important that I say this right now for everybody watching this video, okay? Very important. If the worst we see when it comes to unemployment, by the end of 2023, is something with a 4 in front of it, we won. We won, and the Fed deserves 2 thumbs up for that, okay? Because the way I kind of look at it, I'm like, that seems difficult. If it happens, I will be very happy because, I mean, a lot of people didn't lose jobs that maybe could have lost jobs. But the more time ticks on here, the more I'm concerned that by the end of 2023, there's, potentially mass job losses because of what's likely going to transpire in 2 massive fields that employ, a combined 20 million plus workers, construction and manufacturing. And I just have real concerns, basically starting in 2Q of 2023, and especially as you move throughout the year, that there's going to be potentially millions of jobs lost there. So if the worst thing that happens is 4% unemployment, it's a win. It's a win, okay? We will take that any day of the week because 4% unemployment, by the way, if you're not aware, it's extremely low. It's extremely low. So I would say his team and personally him, they're actually more on the bullish side, much more on the bullish side.
Of internal debate. And frankly, what makes Citadel so special is we have these debates endlessly. And it pushes all of us to think more critically about our perspectives.
I don't know what their debates are about, but they all sound bullish. He sounds bullish. Like I said, your bearish scenario is 4% unemployment by the end of 2023. That's pretty bullish if you ask me.
Views, and of course, ultimately the investment decisions that we make. On inflation, we think we've seen peak inflation. Now, owner's equivalent rent, which is a big driver of inflation, because of the way it's calculated and estimated, we'll see that continue to show inflationary pressure for the next few months. But spot rental rates appear to have peaked in many metropolitan areas a few weeks ago.
Thank you. I can tell you in Vegas, the reality is it already peaked quite a while ago, to be honest, in Vegas. Same out here in Phoenix. And what I'm looking at in those markets is, especially at this point in time, a lot of rentals are sitting on the market and they think they can get certain prices, and those babies just sit and collect dust and sit and collect dust. That's what I'm starting to see a lot out there now at this point in time. It was not like that a year ago. It wasn't even like that really 6 months ago, but it is like that today. And as somebody that's about to rent out a property, I undercut the market because I'm like, I want qualified candidates to potentially rent this place, and I don't want them to just sit and collect dust. So I undercut the market, and you'll see more savvy, folks out there do the same exact thing I just did and undercut the market. And it's that's the beauty of competition, because then at the end of the day, guess what? The person that's renting gets a better deal, right? And that makes everybody start to have to bring down their rents as well, right? So the people that are the landlords, I don't know if they necessarily like me, right? But everybody who's not a landlord does like me. Let's just put it that way. When I started my real estate marketing company, I was not the best photographer or videographer, I can tell you that much. I was probably the worst. I undercut everybody. And I undercut everybody's price. And, maybe other photographers didn't like me, but I was stealing all their business. And next thing you know, I had, I don't want to say the most successful business in that market, but certainly one of the most successful. I undercut everybody. And I took care of things and always made sure everything was done properly and professionally, and knew how to talk with, folks, clients, including high net worth individuals, and, filming these homes at that time that I couldn't even imagine affording some of these homes that I was filming, $3 million, $4 million homes. And, you gotta figure out in the market. What am I even talking about? I'm so far off subject now. Holy smokers! What are we talking about? Real estate marketing business back in the day? What? How did I even go there?
We think that one of the biggest drivers of consumer prices, which is rent, has reached a near-term peak. And then energy prices are likely to roll over in 2023 as compared to their 12-month prior. So two of your really big drivers of inflation, energy.
I'm worried I might be getting old now and just start talking about random stuff. Like how did I even get on the subject? Where do we go here? What happened?
Rent, we think we've seen a peak in. And then across goods, we think this is going to be a really good holiday season for consumers because American companies have built up such a substantial inventory of goods that they're going to need to sell here heading into the holidays. So we think we're going to see pretty good pricing for consumers as goods become very attractively priced to move them out of warehouses. Now, why is that? Obviously, in the pandemic, you couldn't enjoy services. You couldn't take a vacation. You weren't getting a massage. You weren't going to dinner with friends. So you bought a lot of goods.
Unless you were me. I didn't care about any of that. And as Kevin said on Millennial Money one time, he said, what did he say? He said, yeah, that's why you got Rona. Dang. He got me good there, I will say that.
I mean, I can't imagine how many flat screen TVs were sold.
I did have Rona in 2020, if everybody didn't know. And that was, back then, that was like serious strain, man. That was no joke. I had Rona this past year. That was like nothing. But man, I had it in 2020. It wasn't easy, actually.
Americans in the pandemic that are frankly not used nearly as much today as they were a year ago. So this shift from a goods-based economy to a service-based economy is going to create this depreciation in pricing of goods, which of course will help bring inflation down. So we think the inflationary path has peaked.
And to explain that in the simplest terms possible, instead of buying, I don't know, a new iPad and spending $400 on a new iPad, you spend $400 going to the big musician's concert, right? For you and your girlfriend or something like that. Like that's basically what he's talking about there in terms of, before in Rona, you were spending money on goods, an electronics product, whatever. And instead, you're spending that money on an experiential type thing. Maybe it's a vacation, maybe it's concert, maybe it's a football game, whatever.
We think by the end of 2023, our central view is inflation will be back to roughly a low to mid twos range, which is a dramatic change from where we are today.
Some Fed officials, and of course it's so important to talk about the Federal Reserve, it sets the risk-free rate for the rest of the world and of course has created unbelievable complications with the strength of the dollar for emerging markets. Some Fed officials can say the time has already come to back off.
Imagine this happen, okay? Imagine the Fed goes so far with things. And I don't think most people are even thinking about this. Imagine, let's say we're a year into the future. Imagine if instead of inflation rate, there's actually deflation. Could you imagine that? Like, I'm not predicting that. I just want to throw that out there because sometimes it's good to just explore these ideas or thoughts of like, what if this happened, right? Like, I never even thought about that. Could you imagine? Like, what if a year from now, it's like we're talking about like 2% deflation. Like that would just be insane to even think about that because, everybody's gotten so used to inflation now to even think about anything but inflation. You can't, your mind and your brain almost can't even go there.
I could cite Charles Evans. I could cite Lael Brainerd, who didn't say it's time now, but it will be time soon. Are we there yet?
It's sort of like saying you go to your doctor, you've got a bacterial infection, and he gives you 10 pills to take, and you stop taking them after pill number 7. And then you relapse a few days later. Like, it's not yet time for us to...
Respect for that analogy. Oh my gosh, that was good. Like I said, I don't know, I guess Ken Griffin was getting a bunch of hate a year or two ago, but dang, that's a 10 out of 10 analogy. That's all I'll say about that one.
Change course on our monetary policy. We want to see that we put the inflation genie back in the bottle. We've endured a ton of pain in getting to this point. The housing market is definitely under duress. Durable goods sales
you ain't seen nothing yet, Mr. Griffin.
Duress. High ticket items are just out of reach of consumers today, but we haven't gotten the job done. And to take the foot off the brake right now and not finish the job, I think is the absolute worst mistake the Fed could possibly make.
Why? What happens if they, again, back off too early? If you take only 7 pills instead of 10, what are the consequences for the U.S. economy and for the global economy furthermore?
So the biggest concern is you on-anchor inflation expectations. So right now, the American public believes, and not as much as we'd like, but the American public believes the Fed's going to get the job done. If we take the foot off the brake, we don't finish the course of antibiotics, and inflation starts to flare back up, the Fed will have lost credibility. If the Fed loses credibility and inflation expectations on anchor, then the amount by which we'll need to raise rates and deter economic growth will be a much bigger bill to pay. And we shouldn't put ourselves in a position to pay that bill. We should get the job done now.
So a very interesting perspective there, especially at the end. But the one thing I'll say about that is, he just said, right, that the American public believes the Fed's going to get the job done. I mean, does the American public even care about the Fed or know what the Fed's up to or what they're doing or things like that? I just have doubts about that, to be quite honest. I know myself and all you guys watching this, we're in tune with all this, right? But I don't think, most people have any clue what the Fed's up to, what they're doing, why they're doing it, or anything like that. And, I was speaking to a friend about this recently, and he was telling me about, he's got some people he knows that are still buying homes in 2022, right? And they're just completely kind of naive to what's been going on. And now they're in a situation where they were building a home and they were planning on, when they started the project, it was like, obviously mortgage rates were in the high 2s, and now they're looking at a mortgage rate of 7 or 8, and they're like, what? And so they're trying to lock in the rate now, and it's just like obviously an insanely expensive price compared to what was, when they started the project and whatnot, right? So I'm just not so sure a lot of Americans are really that tied in that they have any clue what the Fed's up to, what they're doing, why they're doing it. All they know is prices are really high. They've been going higher, and they don't like that.
Not believe it. I mean, it's been a pretty powerful bounce.
Yeah, I mean, look, I think if we just take a step back and just look at kind of the simplest definition of trend, I think a lot of people just continue to want to fight what we view as a pretty established downtrend. I mean, if you're talking about the S&P 500, peaked at 4,800 in January, we made a lower high 4,600 in March, and then another lower high 4,350 in August, and here we are at 4,000. So we're still 350 points below the August high, and yet there's a lot of talk about this new sustainable market. But I think, when you do take a step deeper, obviously, and we want to look more than just at the surface.
New sustainable market, I don't know if there's that much talk about that. I think either the talk really is it's just a bear market rally that's going into year end, or it's just a very, very short-term rally.
What's going on under the trend, it continues to be, by all accounts, a somewhat defensive-led rally. And one of the things we can look at is the relative performance of the Dow Jones Industrial Average relative to the S&P 500. That's still, even after the 2-day underperformance last week, the Dow is still outperforming the S&P by 6.5% from early October. So that trend has been in place for a while. And if you look at the major bear market bottoms, whether we're talking about 1982, 2002, 2009, or most recently March of 2020, all of those consistently saw the Dow underperform the S&P. So we're seeing the opposite right now. Again, not saying maybe it's different this time, but by our work, we're still a bit skeptical here.
Well, I mean, maybe it is different this time. Are you fully appreciating enough the move from growth to value? It would obviously show up.
So I think obvious, I think you can always say these things have never happened or this hasn't happened, but also in the past 60 years, we've never seen the stock market not go up 6 months after, primaries, right? Or midterms. We've never seen it in the past 60 plus years where markets didn't go up and usually go up substantially 12 months after midterms. So you could look at something like that and be like, well, is this the one time it's going to be different? The first time in 60 plus years that after midterms, we aren't substantially higher in the S&P 500, 6 months down the road, 12 months down the road, right? So, I think those are just factors you kind of got to think about, right?
In the kind of metric that you're sort of throwing water on.
Well, we do think small cap value actually, should do fairly well here. It's kind of been under
Small cap, did you say, sir? I like you now.
performing for the last 4 or 5 years. Your previous guest talked about some similarities and analogies to 2000 to 2002, which we think are applicable. And small cap value actually did very well then. But again, if we're talking Dow Jones, which is yes, it's value, but it's also, the largest component right now is UNH, which is, pretty defensive. If we're talking purely on the Dow, it just doesn't feel or look historically like a lot of bull market, the new bull markets.
Yeah, interesting. So, I think the longer the rally goes for that we're in right now, I think the more the believers are going to come to that side, right? I think if this continues for at least another couple weeks, I think then you're going to really have almost everybody get over to the camp of like, we're at least having a rally into year end. Then if the rally continues after year end, let's say hypothetically, and that's a big debate if that will happen, right? But let's say we start to get into January, the rally's still rolling. Then you're going to have folks that are going to start to go to the ultra bullish camp and start to say, 2023 is going to be a great year. You'll have, folks start to, say that big recession they were talking about, we're not going to have it. And here we are with a Fed that's about to turn and inflation that's going down. And, all the things that worked against us in 2022 is going to be working for us. Never mind what happens if things get better between those two countries that are fighting right now and there's some sort of agreement there. And what if China comes back online, right? And they actually fully open back up their economy for real. People are going to look at those things, right? And then they'll start to go to that full bullish side and they'll be like, oh my gosh, there's all these things going, right? Now, behind the scenes, if interest rates are still insanely high, then you're still going to see massive problems in the construction field and manufacturing field toward the end of 2023 and even starting probably in the middle of 2023. So the only way that story is really saved is if the Fed was to lower interest rates in a substantial way in 2023. But the thing is, when it comes to that, they might only do that if things really start to fall off a cliff. If everything's kind of okay, especially for the first quarter of 2023, like let's say earnings come out for, the fourth quarter, and those will come out toward the end of January and February. And let's say those earnings come out and they're okay. Then the Fed can look at that and be like, okay, inflation's, going down and down and down. We have already raised rates immensely. But, earnings are okay for these companies. It doesn't look like the economy's falling off the rails. Why don't we just keep rates where they're at, right? And I'm telling you, even if you keep rates where they're at, in 30-year mortgages are still 6-7+%, and it's still very expensive to take out loans and to, build and those sorts of things. I still think at the end of the day, like home construction will dry up as the year goes along. Apartment construction, condo construction, warehouse construction, office construction, and what I call random project construction will still dry up, and the manufacturing field would get hit in a massive way as well. So, that's just kind of my 2 cents on that. Hope you guys enjoyed today's video. As always, I appreciate each and every one of you that subscribe to this channel. We have, 19,200 plus subscribers at this point in time. And once again, we got that massive sale coming up on Black Friday to join the private stock group and get access to everything in there. So if you ever wanted to, get access to everything that's included inside the private group, this is your, obviously phenomenal opportunity there. And that will be pinned to comment down there. Much love and have a great day.